Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of why the Dodd-Frank Act matters to your investments. Understanding the Dodd-Frank Act, key provisions, impact and ongoing debates. When the 2008 financial crisis shook global markets, it exposed serious gaps in the U.S. financial system. The Dodd-Frank Act was introduced to address these issues, aiming to increase transparency and reduce risky practices in the financial sector. This sweeping legislation reshaped how banks, lenders and other institutions operate, with the goal of protecting consumers and preventing future crises. Whether you're a financial expert or just curious, understanding this law's impact is essential for grasping the modern financial landscape. Background of the Dodd-Frank Act. The Dodd-Frank Act didn't appear out of nowhere. It was the product of hard lessons learned during one of the most chaotic financial periods in modern history. To understand this law, it's important to explore the events and failures that led to its creation. The 2008 financial crisis. The 2008 financial crisis wasn't a random event. It was years in the making, driven by risky lending practices, overly complex financial products, and insufficient oversight. Mortgage lenders, for example, freely issued loans to borrowers who often couldn't repay them. These bad loans were bundled into securities and sold throughout the financial system, spreading risk like wildfire. When the housing bubble burst, billions of dollars in investments evaporated, and major financial institutions buckled under the weight of their losses. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy, sending shockwaves through the global economy. The crisis exposed a stark truth. Existing financial regulations weren't strong enough to prevent irresponsible behavior or manage such widespread risk. Why did this matter? Because millions of people lost their homes, jobs, and savings. The ripple effects reached beyond Wall Street, devastating everyday families and businesses. It became clear that regulatory reforms were essential to prevent a repeat of this disaster. Previous regulations and their failures. Before Dodd-Frank, there were regulations meant to govern the financial sector, but they weren't enough. Many were outdated or limited in scope, leaving loopholes that banks and institutions could exploit. The Glass-Steagall Act. Passed in 1933, this law was designed to separate commercial and investment banking to reduce risky behavior. However, by the late 1990s, many of its provisions had been repealed, allowing banks to merge these activities once again. The Commodity Futures Modernization Act, CFMA. In 2000, this act excluded certain financial products, like credit default swaps, from government oversight. This lack of regulation allowed untested and poorly understood derivatives to flourish, contributing massively to the 2008 crisis. Weak oversight agencies. Agencies like the SEC faced criticism for failing to oversee risky practices adequately. Notably, they didn't act to curb predatory lending or scrutinize the burgeoning derivatives market. These earlier rules failed because they didn't adapt to the innovation happening in financial markets. They weren't prepared for the complexity or global scale of modern banking. The result? A system ripe for abuse, where institutions prioritized profit over stability or fairness. By 2009, it was painfully obvious that significant change was needed. Regulatory gaps had allowed excessive risk-taking, poor accountability, and dangerous products to thrive. Reform wasn't optional, it was unavoidable. Key provisions of the Dodd-Frank Act. The Dodd-Frank Act introduced a comprehensive set of rules and institutions to address weaknesses in the financial system. These provisions targeted key areas like banking practices, consumer protection, and risk management. Below, we break down some of the pivotal components that define the Act. The Volcker Rule. The Volcker Rule, named after former Federal Reserve Chairman Paul Volcker, was designed to curb risky behavior by large financial institutions. Specifically, it bans banks from engaging in proprietary trading, where they trade for their own profit rather than on behalf of clients. What does this mean? Banks can no longer gamble with depositors' savings on high-risk investments like stocks or derivatives. It also limits their relationships with hedge funds and private equity funds, reducing conflicts of interest and excessive risk exposure. By focusing on separating everyday banking activities from speculative trading, the Volcker Rule aims to create a safer financial system less vulnerable to sudden shocks. This is especially crucial in preventing too-big-to-fail scenarios that require taxpayer bailouts. Consumer Financial Protection Bureau, CFPB. The Consumer Financial Protection Bureau, CFPB, was established to safeguard consumers from predatory practices in the financial sector. The Bureau enforces standards for transparency and fairness across industries like loans, credit cards, and mortgages. Some of its major initiatives include ensuring lenders provide clear terms on loans and credit products, protecting consumers from deceptive or abusive practices, investigating complaints and taking enforcement actions against violators. Think of the CFPB as a watchdog, ensuring that financial institutions treat their customers fairly and follow the rules. Its formation was a major step in addressing the unchecked practices that contributed to the 2008 crisis, such as subprime lending and misleading loan agreements. Derivatives regulation. Derivatives were at the heart of the 2008 financial crisis, and Dodd-Frank brought much-needed oversight to this intricate market. The Act requires most derivatives to be cleared through central clearinghouses and traded on regulated exchanges. Key changes include clearing requirements, ensures a third party guarantees the transaction, reducing the risk of default. Reporting obligations. Mandates that details of derivative trades are reported to regulatory bodies, improving transparency. By introducing these measures, the Act reduces systemic risk in the markets. It's like insisting on road inspections for heavily used bridges. Without them, the entire structure could collapse. Resolution authority. One of the most striking lessons from 2008 was the chaos caused by the failure of giant financial institutions like Lehman Brothers. Dodd-Frank tackled this by giving the government resolution authority to wind down failing firms in an orderly fashion. Here's how it works. The Federal Deposit Insurance Corporation, FDIC, is empowered to step in and take control of a failing institution. Creditors and shareholders bear the losses, not taxpayers. The plan aims to avoid market chaos, protect the broader economy, and prevent bailouts. This authority essentially acts as a financial safety net without rewarding poor decision-making, ensuring that no single firm's collapse can grind the system to a halt. Executive compensation guidelines. The Dodd-Frank Act addressed widespread concerns about runaway executive pay and its role in incentivizing risky behavior. It introduced new rules to ensure accountability, fairness, and transparency. Significant provisions include say-on-pay. Shareholders must be given the right to vote on executive compensation packages. This vote may be non-binding, but it forces companies to consider shareholder opinions. Clawback policies. Firms must set up rules to reclaim executive bonuses if they're based on inaccurate financial statements. Disclosure requirements. Companies must disclose the ratio of CEO pay to the median worker's pay, shining a light on income inequality within firms. These guidelines push corporations to adopt better governance and align executive rewards with long-term performance, not short-term, high-risk gambles. Impact of the Dodd-Frank Act. The Dodd-Frank Act reshaped how the financial industry operates, leaving a significant mark on banks, businesses, and the economy. From stricter rules on risk management to greater consumer protections, the Act was designed to ensure we never face a crisis like 2008 again. But how has it changed the day-to-day practices of banks? And how has it influenced broader economic stability and growth? Changes in banking practices. Banks faced a major overhaul after the Dodd-Frank Act came into play. It wasn't just about following new rules, it was about fundamentally changing how they did business. Here are some of the most significant shifts. Increased compliance costs. Banks must now dedicate substantial resources to legal and compliance teams to meet regulatory standards. This is particularly true for smaller banks, which often find these requirements harder to manage compared to larger institutions. Stricter lending standards. Loan approvals have become more selective. Banks now heavily scrutinize borrowers, which has helped curb risky lending, but also made it harder for some individuals and small businesses to access credit. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.